Welcome to Market Brief After Hours. We are stepping into April with a noticeable shift in the financial winds. After a highly volatile March, global markets are opening on a much firmer footing. We are seeing risk sentiment get a solid boost as oil prices finally pull back from their historic highs, and equities are eagerly adding to the gains we saw at the end of last month.
It really is a fascinating start to the quarter. March was an absolute roller coaster, heavily dominated by energy spikes and geopolitical headlines. But right now, we are seeing investors rotate back into equities with some serious conviction. The anxiety hasn't completely vanished, of course, but there is a palpable sense of relief driving this broad-based strength.
Let's get right into the numbers, starting with Wall Street. The major U.S. indices put on quite a show today. The Dow Jones Industrial Average extended its gains, rising 0.48% to close at 46,566. The S&P 500 advanced 0.72%, finishing up at 6,575. And the Nasdaq Composite really led the charge, climbing 1.16% to settle at 21,841. It seems like technology stocks are suddenly back in favor.
They certainly are. That 1.16% jump in the Nasdaq highlights a renewed appetite for growth names. Tech took a bit of a beating recently due to yield sensitivity and macroeconomic pressures, but today's bounce shows that buyers are willing to step back in. The S&P 500's move to 6,575 is also incredibly telling because the strength was broad-based across almost all sectors. It wasn't just a handful of mega-caps doing the heavy lifting, it was a genuine market-wide rotation.
Beyond the equity tickers, we got some major economic data today that paints a really interesting picture of the U.S. economy. Let's talk about the ADP jobs data first. Private sector employment increased by 62,000 in March. That completely blew past the expectations of just 39,000.
That was a massive beat. What stands out to me is where those jobs are being created. The gains are highly concentrated in healthcare and construction. So while the headline number of 62,000 is robust and shows the labor market is still humming, the strength is actually quite uneven underneath the surface. It's not across-the-board hiring, which is something to keep an eye on.
We also saw the ISM Manufacturing Index rise to 52.7, and retail sales for February came in hot, increasing by 0.6%.
Exactly. An ISM reading of 52.7 indicates continued expansion in the manufacturing sector. When you pair that with retail sales jumping 0.6%, which also exceeded expectations, it points to incredibly solid consumer demand. People were still spending confidently right before this recent escalation in energy prices. The big question going forward is whether that consumer resilience can hold up if costs at the pump stay elevated.
Speaking of costs at the pump, we have to talk about oil. We saw a pullback today with WTI settling at $100.12, down 1.24%, and Brent falling 2.7% to $101.16. But let's put this in context. This comes after an extraordinary rally of more than 60% in March. That was the strongest monthly gain since 1988.
It was a historic surge without a doubt. A 60% jump in a single month is the kind of volatility that completely rewrites economic forecasts. Today's pullback to around the 100 and 101 marks offers a little bit of breathing room, but let's be clear, prices are still exceptionally elevated.
And a lot of that seems tied to the ongoing supply disruptions, particularly around the Strait of Hormuz.
That is the critical choke point. Roughly 20% of global oil flows pass through the Strait of Hormuz. So while there might be some easing of immediate panic, the physical reality of supply chain disruption in that specific corridor is keeping a very high floor under these prices. The market remains hypersensitive to any headline coming out of that region, which means we shouldn't expect this volatility in energy markets to disappear overnight.
We'll take a quick break here, but when we come back, we are heading across the Atlantic to look at a massive rebound in European markets, diving into the currency charts and breaking down today's biggest market movers. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the U.S. indices and that historic oil surge. Now, let's look at Europe. European equities staged an incredibly strong recovery today, following what was their worst month since 2022. The pan-European STOXX 600 rose 2.5%, with nearly all sectors advancing.
It was a sea of green across the continent.
Investors there were heavily battered last month, so to see a broad 2.5% jump on the STOXX 600 is a significant sentiment shift.
The country-specific numbers were just as impressive. In the UK, the FTSE 100 climbed 1.70% to 10,350. Germany's DAX surged 2.73% to 23,299. In France, the CAC 40 added 2.08% to 7,979. Italy's FTSE MIB jumped a massive 3.17% to 45,715. And Switzerland's SMI gained 1.68% to 12,991. What is driving this sudden wave of buying in Europe?
A large part of it is a relief rally. When markets get heavily oversold due to geopolitical fears, any stabilisation in energy prices, like we saw today with oil pulling back, gives investors the green light to hunt for bargains. We also got some mixed but overall encouraging data. Eurozone unemployment edged up slightly to 6.2%, but manufacturing activity showed signs of life. The Eurozone PMI rose to 51.6, and Germany's PMI hit 52.2. There is still some persistent weakness in places like Spain and France, but the fact that Germany, the industrial engine of Europe, is showing expansion at 52.2 is giving the markets a lot of confidence.
Let's pivot to the Forex markets because there is a lot of technical action happening right now. Let's start with the euro against the dollar. Euro USD closed at 1.1585, up 0.27% for the day. But looking at the moving averages, it seems like the bears are still in control.
They absolutely are. Even with today's slight bump to 1.1585, the euro is struggling. It is trapped below all of its key moving averages. It's sitting below the 50-day simple moving average at 1.1714, the 100-day at 1.1688, and the 200-day at 1.1676. The broader bias is heavily tilted to the downside. We keep seeing this sequence of lower highs and lower lows since the February peak. If it breaks below the immediate support at 1.1552, we could easily see it slide toward the March low near 1.1440.
The British pound seems to be in a very similar boat. GBP USD rebounded slightly to close at 1.3301, up 0.54%, but it's facing the same technical headwinds.
Precisely. It's capped right below its descending averages. The 50-day SMA is up at 1.3490, the 100-day is at 1.3414, and the 200-day is at 1.3428. Every time the pound tries to rally, it runs into a wall of selling interest. Unless it can break and hold above that 1.3414 zone, the medium-term pressure remains bearish.
Let's look at the safe havens. USD CHF pulled back to close at 0.7948 after failing to break the 0.8000 level. Meanwhile, USD JPY is consolidating near multi-year highs, closing at 158.89.
The Swiss franc pair, USD CHF, is showing a constructive but weakening structure. It's hovering right near its 200-day SMA at 0.7942 and remains above the 50 and 100-day averages. But that rejection at 0.8000 shows momentum is stalling. On the flip side, USD JPY is an absolute powerhouse right now. Closing at 158.89 means it is firmly above its 50-day at 158.66, its 100-day at 158.53, and miles above its 200-day at 152.57. It's a very strong bullish structure, making higher highs and higher lows. The next big psychological test is the 160.00 level.
Before we move on to individual stocks, I want to briefly touch on gold. It had a stellar day, closing at $4,766, which is a jump of 2.01%.
That was a phenomenal move. Target Hospitality secured a multi-year contract worth over $550 million. It's tied to a major data center development in Texas. In a market where investors are looking for clear, visible revenue streams, a $500 million contract is exactly what gets a stock to pop 36% in a single session. We also saw Encino gain more than 10% and Boeing rally over 4%.
Encino gave a very strong revenue outlook, specifically forecasting their 2027 subscription revenue to come in well above consensus expectations. The market loves forward-looking confidence. As for Boeing, that 4% climb was driven by Wall Street. Wells Fargo initiated coverage with an overweight rating and slapped a $250 price target on the stock, which brought a lot of institutional buyers off the sidelines.
On the flip side, it was a brutal day for a few companies. Oric Pharmaceuticals plunged over 40%. RH fell more than 19%, and Nike slid over 15%.
Oric is a classic biotech story. The stock collapsed 40% because of severe concerns over limited data and a lack of clear efficacy differentiation in their trials. In biotech, if the trial data isn't pristine, the market shows no mercy. RH dropped 19% because they projected a revenue contraction, completely catching investors off guard who were expecting growth. And Nike falling 15% is a major story. They essentially warn the market that their turnaround efforts are taking much longer than anticipated. When a blue-chip consumer brand like Nike admits they are struggling to right the ship, investors are going to reprice the stock immediately.
It really highlights how stock-specific the market can be, even on a day when the broader indices are flashing green. We have a lot of optimism right now with easing oil prices and a strong start to April. But between elevated inflation, shifting treasury yields, and ongoing supply chain disruptions, it feels like volatility is far from over.
That is exactly the right takeaway. The equity response today was positive, and the macroeconomic data, like the ADP jobs and ISM manufacturing, show underlying resilience. But the structural risks haven't disappeared. Yields are still edging higher, and energy markets remain highly sensitive. It's a market that requires investors to stay nimble.
A perfect summary to end on. If you find this useful, please follow Market Brief after hours. We'll be back tomorrow to break down all the latest market action. Have a great evening.